Okay, good afternoon, everybody. Thank you for joining us this afternoon for the latest installment of the World Trade Center Utah webinar series. We're so grateful to CBRE for Darren and David and Lloyd for being with us today to talk about commercial real estate in a COVID-19 world. We know that there have been disruptions across the economy. And it's interesting because if we think about real estate is something that affects each and every one of us, whether it's the office space that we are working in or our homes that we're living in. Real estate is the backbone of the economy. And so it's so important for us to understand how this pandemic is affecting the commercial real estate markets here in Utah, and what that means to all of us as business owners. And so again, thank you to CBRE for being with us, and thank you to Lloyd, Darren, and David for taking time out of their busy days to help us understand this important issue. Before I turn the time over to them and we dive into this, I just wanted to provide a quick update. As many of you are aware, World Trade Center Utah has been leading the Federal Committee for the Governor's Task Force and working very, very hard to help as many Utah small businesses access the federal programs and resources that are available to help companies to do things like pay payroll and pay rent and their mortgages, which is so important to the real estate industry. We've all seen the news today about funding running out for the Paycheck Protection Program. We've had about 13,000 Utah businesses apply, have PPP loans approved, valued at about $2.7 or $2.8 billion. So this has already injected a tremendous amount of capital and cash into Utah's economy. And yet we still have many more companies who are applying or about to apply and now are caught up in a holding pattern as we wait for Congress to appropriate additional funding. What I thought I'd do is just, since it's such an important issue, just give a quick update on the issue and a couple of recommendations depending on where your small business or small businesses that you're working with may be in the process. And so if you've already applied and you had notification that your loan was approved, but you haven't received funding yet, check with your lender, but you should still see your funding come through. If you've applied and you hadn't had confirmation that your loan was approved, then unfortunately, banks or lenders are not able to approve any more loans until Congress acts to appropriate more money. And so you won't lose your spot in the line, but you'll have to wait in line until Congress does its job, at which point these programs can resume. If you hadn't applied yet, and this is really important, we still encourage you to apply. And if you own commercial real estate and you're working with your tenants, working through rent issues, continue to encourage them to apply for the PPP loan if they're a small business, less than 500 employees. Confirm you're eligible, get your documents in order, get your application in, because most lenders are still accepting applications. That then gets you in the system. Once Congress appropriates more funding, then you'll be able to go through, get your loan approved, and get this funding that is so important for small businesses. If you have any questions or your tenants have any questions about this, or they're looking for assistance, they can go to coronavirus.utah.gov/business. We have stood up a rapid response team of 50 plus volunteers from 15 different organizations. And they are there. You can go to the website and request assistance. They are there, then plug in and help provide one-on-one assistance to small businesses. And with that plug, let me go ahead and introduce CBRE, and then I'll turn the time over to Lloyd. CBRE is a full-service professional real estate firm. It operates worldwide, providing commercial real estate transaction, valuation, property management, and consulting services. The 140 people in the Salt Lake City office provide a full range of commercial real estate services. And CBRE is also an active member of World Trade Center Utah. David Bauman has been serving on the board of directors for World Trade Center Utah and on our finance committee for several years. And so I'm grateful for Dave and everything that he does to make sure I don't take things too far off the rails. And Lloyd and Darren have been great colleagues. Darren serving on the Governor's Task Force, and Lloyd has been leading out on CBRE's corporate relationships and government relations, and just being such a critical member of the Utah business community. So it's great to have the three of you with us today. And with that introduction, Lloyd, I'll kick it over to you, and then you can take it from here.
Miles, thank you. We appreciate the opportunity to spend a few minutes talking about commercial real estate today, and I'm pleased to have Darren and David with me. Can I first start out with saying, though, that we extend our best wishes to those who are certainly directly dealing with the COVID-19 problems, and all of us who are indirectly dealing with it. We wish all on the call well and hope that they're able to deal with matters that they have in front of them. Mike, quick introduction. My role is to manage CBRE's operations in our geography in an overall way. I play that role as a managing director and a principal broker. I have with me today Darren Malott. Darren is the director of research for the Americas. Darren plays a key role in CBRE's overall research and overall data-driven approach to things. We are lucky that we have Darren, who has also some close ties to Utah. That helps us get him on with us today, and that includes the fact that he plays a role as a senior advisor to the Gardner Institute, and also is a senior member of the Utah Economic Council and working on the governor's COVID task force. Also, David, well, and Darren will spend a few minutes today giving a overall macro economics view of what's happening in the world and how that's affecting commercial real estate. David Bauman is the Director of Global Advisory and Transaction Services. He operates here in Salt Lake and manages a large transaction management team that does transactions around the world. And David will take time today to share with us just practical workplace issues that are being driven by the COVID-19 issue, and also talk about some significant aspects of relationships between landlords and tenants. With that, Darren, can I turn it over to you for a macroeconomic overview?
Absolutely. Thank you, Lloyd, for that kind introduction. Well, perhaps needless to say, we are in a global recession, and Q2 will be absolutely brutal, with GDP falling by a record amount during the quarter. On an annualized basis, we expect GDP to contract by at least 32.5% during the second quarter, and risks to the downside remain to that forecast. Now, to give some perspective, quarterly records began in the 1940s, and the previous record was just over 10% in the recession of 1958. This sharp drop in output is leading to excruciatingly fast employment losses, and we think that we will quickly pass the 10% unemployment peak of the Great Recession. In fact, we think unemployment is likely to rise to somewhere close to 15%. And I would also note that although several industries, notably the travel industry, food and beverage, retail, were hit hard early on, that the job losses are extending beyond those hard-hit sectors. Now, we expect stabilization to begin in Q3, but we think that this is likely to be a process of stabilization. And what do I mean by that? Well, first, let's start with the idea that there may be some seasonality to this. Other respiratory viruses have had a seasonal element. That will help us as we begin to loosen things up. And much will vary state by state, but testing will be key to spotting the virus and containing it as it pops up. This will be particularly important as we approach the autumn. Now, risks to the second half recovery forecast exist, but not necessarily in a directional sense. We think there will be volatility. And what do I mean by that? I started by talking about seasonality and talking about testing for a reason. And it's because we may see some localized pumping of the brakes as officials have to react to new outbreaks as they occur. Now, provided other states, like our state where we have mass testing capabilities, we can be more surgical in those closures and restrictions than we have in the past. And I would also mention that there's particularly some risk as we head into Q4, because a therapeutic will be key for strong growth in that quarter and through the winter months, as the virus is likely to stay in circulation and spread becomes more prevalent amid the colder season. Now, as the recovery takes hold in the second half, we think that we'll end the year with the US economy and GDP contracting by 4.3%. While I'm describing an unprecedented sharp drop, It's important to remember that this recession was brought about by restrictions, not endogenous problems or imbalances that have built up in the economy that weren't sustainable and markets ceased to function. A good way to think of this is similar to a natural disaster. Consumption is inhibited temporarily, business activity halts, but we don't have the constraints of destruction to restrain the recovery. So with the right policy mix, emergency liquidity is provided and economies recover from disasters. And that's exactly the reason why we've seen policymakers move to provide needed liquidity, including the Paycheck Protection Program that Miles just mentioned. The idea of this is to preserve employment relationships. This enables consumption, and it also preserves the supply side of the economy so that output can resume as quickly as possible. Now, we think that the unprecedented fiscal policy, both in its speed and size, coupled with the lagged effects of monetary policy, will propel growth, and the US economy will grow by 5.6% in 2021. We will not approach pre-COVID levels of unemployment, but we will be getting close to 5% unemployment by the end of 2021. And 5% is what I mentioned because that's widely considered to be the number at which the US economy is at full employment. Now, the real estate market and recovery will vary by market, but it will lag the real economy by several quarters. Markets such as Salt Lake City, with diversified economies and favorable demographics, will recover more quickly. But similar to the Great Recession, we will feel the full force of the downturn here, but we are positioned to bounce back faster. So to summarize, we're in for a scary and deep, but somewhat short-lived recession, with recovery starting in the second half of 2020 and very strong growth in 2021. So with that, hang in there, stay safe and healthy, and thank you.
Darren, thank you. We appreciate that economic overview and the couple of ties, or the good ties, to the commercial real estate industry. My objectives in the next few minutes is to take each real estate specialist or specialty or special sector and give you a little bit of a national view of what we expect to happen there, and then some local details. I will look at first office, and then second retail. Third, I'll take a look for a moment at the industrial and logistics sectors, and then finally look at investment and overall capital markets. With respect to office, we expect that office will actually be somewhat insulated from the overall impact on commercial real estate as compared to other sectors. We do expect that there'll be a few exceptions to that insulation. Areas that are very focused on tourism, such as Vegas, will see significantly more aggressive change in their market. Maybe even the oil and gas industry, such as Houston. But with that, we expect that other office sectors will actually perform better than retail, hospitality, and some others. We'll certainly end up with a rise in vacancy. You'll see also sublease space coming back into the market. And those factors will drive a significant slowing. Locally, it's interesting to take a look at what's happening. Some of the local office experts will say that 9 out of 10 deals for them have been put on pause. The one that's critical, the one that has to happen, is going forward, but literally 9 out of 10 have been put on pause. Interesting that there will be a slowing, or the office will actually have a little bit of a cushioning because there was a slowing in construction over the last year or so. That's not particularly true for Utah. We ended 2019 with over 3 million square feet under construction. Compared that to 2018 that only had 1.2 million square feet. The silver lining in all that is, of that 3 million square feet, literally 55% of it was pre-leased. There's a local transaction that's been a year and a half in build-to-suit that delivered this week. Beautiful new corporate headquarters, all new furniture. Now the challenge is it's empty and there aren't people in it, but hopefully that's a short-term challenge. So the office sector will certainly see slowing. the questions to be left for office is whether the changes we're seeing now will change our market to a tenant-driven type of market as opposed to an owner one that has been for the last couple of years. A question about some of the pausing. Is that really a function of players stepping back and saying, we'll wait and see what June and July bring, and if there's an opportunity for better negotiations at that point in time? Let me turn to retail. Retail is undoubtedly going to be the hardest hit sector with respect to the current economic change. The exception to that a little bit will be grocery and pharmacy, who will be the most resilient, and some of the surrounding centers that are around grocery and pharmacy. Retail is going to be the first to seek relief. In fact, if you are a retail owner or a retail occupier, you have probably already and should have, or probably are seeing some of those discussions with respect to your people. Nationally, we've seen powerful chains like Brio close 71 stores. We hope just temporarily. You've seen some of the headlines from a cheesecake factory saying that they will not be paying April's rent. Here's the silver lining in that, though. If you look at the Michaels, the Joann's, the Hobby Lobbies, in those areas where they're open and operating, they're doing well. Dollar Tree, Family Dollar, those are all retailers that are going to be able to weather this well and find a little bit of strength. But certainly next to the hotel and hospitality business, retail will be the hardest hit. Locally, our story is very consistent with the national situation. A positive lining locally is that we had higher vacancy the last year or so because of a number of mid-sized box stores. And a number of those have been absorbed by the Planet Fitness, the Vasa Fitness, and even some Shopkos. We just had a Shopko close with Utah State University purchasing that to be a satellite location. Industrial and logistics. Industrial and logistics will certainly see a short-term slowdown. They'll see a modest increase in vacancies. They will see, a short-term change in their mode of operation. Long-term industrial and logistics may benefit from the overall change that we'll see in society. They're going to see stronger e-commerce growth. They're going to see stronger inventory control. And so overall, although industrial and logistics, warehouse, manufacturing type of sectors will slow down, that will be the first sector to recover and probably benefit in some ways from the change. Locally, if I talk to some of the local experts who are out in the warehouse sector, they will say that it is busy. We have the benefit of being a crossroads. That means a crossroads for grocery distribution, a crossroads for rail type of distribution. That is keeping our industrial and our logistics sectors going well. There is a challenge that may come through with respect to local industrial and manufacturing facilities, and that is that we have over 7 million square feet that is in construction. That's literally twice what we had at the end of 2018. But the silver lining to that, one could project, I think quite reasonably, that we'll see availability go from 5 to 5.5%, and we'll see an increase in vacancy from 4.5 from 3.5 to maybe 4. Those are still healthy market elements with respect to our warehouse and our manufacturing sector. Last point for me to hit on just a little bit is an overall look at our investment sector. It has certainly slowed, but it hasn't completely stalled. There is certainly change going on with respect to interest rates, with respect to underwriting and the like. But let me use multifamily, and I'll use multifamily because it is one of the most robust sectors of the last couple of years, where literally half of our investment or capital markets has been in multifamily. The fact is that the short-term aspect of what we think we're experiencing now will mean that renters will continue to need a place to live and that they won't wholly change their behaviors. Couple that with some of the federal policy changes of a 120-day moratorium and a 90-day forbearance for those loans which have federal backing. That will allow things to go on and go forward. Although you're going to see a change with respect to underwriting practices and a change with respect to other details of financing matters. For example, we saw a transaction this last week that was set to have a 59% loan to value ratio and a 3.9% rate change to a 50% loan to value ratio and a 4.5% rate. Those are significant gaps for parties to try and close when it comes time to closing a deal. CMBS will certainly pause more aggressive underwriting. Lastly, a couple of positives. We see a very good deal that will close next week, aided a little bit by seller financing, but will still close. We've seen a couple of other good deals close this week with a little bit of change and modification, a 4 or 5% change to pricing. That's what I would say about the capital markets. And I hope that's valuable with respect to what we're seeing in each of the specific sectors. Dave, with that, can I turn it to you to give some practical advice with respect to commercial real estate?
Great. Thank you, Lloyd. Thanks, Darren and Miles. And the last few minutes that are remaining, I'm going to focus on discussions that many tenants and landlords have been having with respect to unforeseen challenges caused by COVID-19. And then before finishing, I'll share a few CBRE thoughts on how to now pivot towards reoccupying the workplace once as we see a light at the end of the tunnel, perhaps. So many issues as it relates to tenants and landlords. The most widespread and immediate issue is how to deal with a tenant unable to meet rent obligations, as many of you probably know and are affected by it as well. So we're going to highlight a few clauses that the parties in a lease may want to review carefully when considering rent abatement. And this would be what was contractually agreed to, but I think it's important that we remember that a lease document creates a long-term relationship between a tenant and a landlord. And so at different times, each party will require the other to act reasonably, irrespective of what the lease may say. In today's environment, we believe it is in both parties' interest to not only know the obligations under the lease, but come together in openness and understanding to discuss any hardships created. So a lease is a document that defines the law between a landlord and the tenant. And so as we go through this, consider that every lease is different, and so each one should be carefully studied. You should see here a few clauses that we'll just highlight. The interruption of essential services is a clause that typically lists the essential services to be provided by a landlord. That may give the tenant a right to rent abatement if those services are not provided for a period of time. The clause should be carefully reviewed to see if access specifically is listed as an essential service that the landlord has to provide, and that may be disrupted during the pandemic. However, since most leases do not specifically list access as an essential service provided by the landlord, it would then be up to debate and further review as to whether or not it is considered an implied essential service that the landlord provides. Also, whether or not it's in the landlord's control or not should be considered. In our experience, most buildings are still accessible, and so landlords may rightly be able to demonstrate that access to tenants has not been halted. The second would be force majeure. These clauses consider a party's obligations and how they may be delayed or excused because of circumstances outside of their control, such as natural disasters, strikes, riots, or government restrictions and regulations. However, in most cases, force majeure does not relieve a tenant specifically from paying rent. The third and the fourth, casualty, which governs what happens if there's damage to the building that makes it inaccessible or unusable in whole or in part, may offer rent abatement if access is tied to a casualty event. But these clauses are generally confined to circumstances in which the premises are physically damaged or even destroyed. And so contamination of property may not be grounds for rent abatement under a casualty provision. Finally, condemnation governs what happens if the government takes control of the premises in some way. If the government were to mandate a building closure, for example, the language describing the government's action should be carefully read to see if it is broad enough to cover closures due to COVID-19. Most instances, again, we're not seeing that rent abatement is a provision under condemnation, and that the tenant would be required to look to the government for compensation. Important to note that we direct landlords and tenants to their attorneys for any interpretation of their lease. There may be certain common law provisions as well that are outside of the lease that come into play and might give parties a reason to again, consult with their attorneys. We're going to look at some key clauses inside of, before we move on, these are some questions that if the lease in its, of itself does not provide for specific language around rent abatement, landlords and tenants ought to approach each other and have a conversation. These are questions that you see on the screen that you may want to consider, such as access. Can the tenant access the premises? If it's been accessed but it's not damaged, the tenant may not be able to have a rent abatement, even though the tenant has made a reasonable decision to abandon the premises temporarily. With respect to government action, the tenant and landlord should consider the scope and duration of government action in any discussion about rent abatement. Essential services, most landlords are opting to keep buildings open, clean, secure, in order to meet their basic obligations of the tenant and protect their asset. And damage. Physical damage is often required to trigger, as we mentioned, lease casualty clauses and also certain insurance coverage as well. So again, can't stress enough the long-term relationship between a tenant and a landlord. This should motivate both parties to seek consensus, and both parties will need to be willing to give in order to find a win-win solution. Even in the absence of rent relief under a lease, landlords and tenants may consider a few suggestions. First and foremost, tenants should not simply stop paying rent, as that would likely constitute a default in most leases. So it's much better to have the conversation with the landlord. And those conversations are ongoing with many, many landlords and tenants in spaces. Second, base conversations from a standpoint of need and not leverage. We're all in this together. Third would be transparent. And if you're a tenant, be prepared to show financials to justify that need. Lastly, look beyond the language of the lease and try to find a mutually beneficial solution. These are some examples of solutions that many landlords and tenants are discussing, which include rent deferral. This would be where a tenant receives free rent for several months to be paid back over a short period of time once operations resume. And then this free rent can be paid back in a lump sum or amortized into remaining rent obligations. Month-for-month deferral would be in exchange for several months of free rent. The landlord would add the same number of months at the end of the rent or the end of the term. Blend and extend would be similar, other than the tenant may agree to making a much longer term commitment for many additional years of term in exchange for some immediate rent relief. And lastly, landlords and tenants may be able to use security deposits to pay rent, and then the parties may agree on the right schedule for returning or refunding that security deposit. Lastly, a few considerations to think about as you consider going back into the workplace. This is the big topic now amongst leadership teams. The framework we at CBRE approach this with is to, number one, rethink, number two, reopen, and number three, reoccupy. And these are three very different areas that that all need attention. First, workplace must not only be safe, but it must also be perceived to be safe for employees and customers. This will happen as they hear about what you're doing and see, maybe, and even more importantly, see the efforts being made to make the environment safe. This may mean that you reset your janitorial protocol so that employees see the space being cleaned as opposed to just after hours. This may mean posters or signs around the space to give highlight safety measures. Remember that employees feel vulnerable since they may control the safety in their own home, but they don't have that same level of control in their workplace. Plan ahead, start early. Lead times will be impacted for things like cleaning supplies, hand sanitizers, wipes, as we all probably know. So have a plan and make sure that leaders of the organization are aware. Have a phased reentry that follows state and county guidelines. This may not be as easy as, having block group A and B. You'll need to consider things like who is critical to be in the office, who can continue to work from home, people who may be predisposed to sickness, et cetera. So you may consider reopening safe environments first and avoiding opening communal areas like conference rooms or canteens. Establish entry points to issue materials such as masks. Some have chose to implement temperature screening. Take a look at appliances in the bathrooms that may need to be hands-free replaced. And finally, engage your landlord as a tenant to understand what changes they will be making to ensure safety, and make sure to communicate that with your employees. Lastly, expect your expenses to go up in order to respond and communicate and over-communicate these points with employees. And think about your longer-term strategy, density, spacing of your space, working from home, your sick leave policies, the furniture you occupy you have in your office, your cleaning protocols. All of these are now becoming probably the new norm for a little while or permanently, and so will need to be considered. That's what we have for you in terms of a relationship with landlord and tenant, and a little bit of market updates. You see in the slides here, which we'll be happy to share with Hannah and Miles in the World Trade Center to distribute, so that you can access additional resources on our website related to COVID, whether it's podcasts from our research team, white papers, news articles, et cetera. We hope that you'll reach out to us as well with any questions, and happy, Hannah, to answer any questions that the group may have at this point.
Great. It looks like we just have one submitted question. Someone said they heard that Salt Lake City is providing rent abatement for their property as well as RDA. Can you guys speak on that for clarification?
That's a good question, Lloyd. I'm not aware personally of that, but Lloyd, do you have a comment on that?
I would answer the same. In fact, I saw the question pop up a couple of moments ago and almost started Googling to see what I could find. I have not, from Mayor Mendenhall or from other decision makers in the city, heard a specific statement with respect to, and I read the question to say city-owned property with occupiers in that receiving an abatement, and likewise RDA, redevelopment zone properties. I have not heard of that specifically. If you go back to Dave's points with respect to interruption of services and access, I think the city has been stronger with respect to their stay-at-home directives, which would certainly provide the basis for a very open and a very transparent conversation with the city as an owner. I do know that the federal provisions with respect to housing and with respect to federally backed mortgages both have deferment periods with respect to being able to force the payment of rent. That's the insight I can give, not a complete answer to the question, but I hope helpful.
Great. Thank you so much. Miles, do you want to take it away?
Yeah, absolutely. Thank you so much, Darren, David, and Lloyd. I like this. 35 minutes, focus, key information, going from the big picture macroeconomic all the way down to how to sanitize and take care of your workspaces. So thank you for that overview. And I think about David, rethink, reopen, reoccupy. And then also, I really like, David, what you said about have discussions from a perspective of need, not leverage. We're all in this together, and that's absolutely correct. And so thank you for sharing your expertise with us today. We'll be sure for everybody who tuned in that we'll send out the slides. And then if you have any follow-up questions, please shoot Hannah an email. I'm sure she'd be happy to pass those along to the CBR team so they can get you some additional answers. So again, thank you everybody for joining us. Thank you to CBRE, and we hope everybody has a good afternoon. Bye-bye.
Thank you.
Thank you.
Be well.